Usually, when we talk about a fitness tracker, we're thinking about physical metrics, right? Like heart rate or steps or your sleep cycles.
Oh, yeah,
You
definitely.
go for a run, the app on your wrist tells you your pace, and, if you push too hard, it actually warns you before you pull a muscle.
Right, which is incredibly useful.
Exactly. And today, we are taking that exact same logic and applying it to your bank account, or, well, more specifically, your brokerage account.
It's the idea of monitoring financial discipline with the same objective scrutiny we apply to physical health, catching a bad financial decision before it completely drains a portfolio.
Welcome to the deep dive. Our mission today is exploring that transition from emotional, chaotic trading to data-driven discipline.
Which is a transition every trader has to make.
Yeah, if they want to survive. And we are pulling from the technical documentation, some aggregated user data logs, and a handful of verified case studies provided by a platform called Cybill AI.
It's some really fascinating stuff.
It is. So if you have ever stared at a red screen and asked yourself, why did I just make that trade? We're going to unpack how technology is now like reverse engineering that exact question.
And it's a painful question to ask.
Right. And, I look at this entirely through the lens of data pipelines and algorithmic logic, but you've spent years in the actual trenches of the markets.
Yeah, and the trenches teach you very quickly that the question you just asked, that why did I do that? It's the most expensive question in trading.
I can imagine.
Reading a candlestick chart or drawing trend lines, that's actually the easy part. The bottleneck isn't the market data.
It's us. Right?
Exactly. It's the human sitting at the keyboard.
Yeah.
We are battling massive cognitive biases every single time the opening bell rings.
Loss aversion is the one that always fascinates me from a behavioral economic standpoint.
Oh, it's huge.
Because our brains are literally wired to feel the pain of losing money twice as intensely as the joy of making it.
Right. And that leads directly to revenge trading, which honestly defies all logic.
How does that usually play out in real time?
Well, a trader takes a standard, statistically expected loss of, say, $100. But instead of accepting it as a normal cost of doing business, the brain just goes into fight or flight mode.
So they panic.
Panic or anger. They immediately buy back in, usually with double the position size, just to, punish the market and get their money back.
Just trying to force a win.
Exactly. The ego gets bruised and strategy just goes completely out the window.
Yeah.
You are trying to force the market to bend to your will.
Which never works.
Never. That emotional reaction is the #1 reason retail accounts get blown up. The human element is, without a doubt, the ultimate bug in the system.
Which brings us to the core of what Cybill AI is doing. They are pitching this as a 247 AI trading coach.
And a very objective one at that.
Right. And looking at the documentation, they've trained their models on over 500,000 trades across their 10,000 plus active users.
Yeah.
So they essentially act as this algorithmic mirror.
Which is something a lot of traders desperately need.
Definitely. My favorite example from the user logs involves a feature they call Smart Symbol Search. It basically strips away the internal narrative we build around specific companies.
Yeah, we all have that one stock we think we have a special, almost personal relationship with.
Oh, totally.
You might think you are an absolute genius at trading Tesla because, I don't know, you drive one, you love the company, and you read every single Elon Musk tweet.
Right. You feel like you know it better than anyone else. But you run your historical broker data through Cybill, and the AI bluntly points out that despite your affection for the company, you have a dismal 12% win rate on TSLA.
It's a harsh reality check.
It doesn't sugarcoat it at all. It just mathematically suggests you stop trading that specific ticker. It forces a confrontation with the reality of your results rather than, the fantasy of your intentions.
But here is where the technology has to really prove itself.
Yeah.
Because identifying a bad win rate on a specific stock, that is just basic arithmetic.
Sure, any spreadsheet can do that.
Exactly. The real challenge is the behavioral side.
And I actually have to push back on their core premise here a little bit. Because the company claims the AI can detect complex human emotions like revenge trading or FOMO.
Right.
But at the end of the day, Cybill is just looking at a CSV file or an API feed of broker data. We're talking about raw numbers, timestamps, ticker symbols, buy, sell, price. volume.
It's just the math.
Right. Code does not know if I'm sitting at my desk furious or perfectly calm.
Well, the thing is, the AI isn't trying to read your mind or measure your blood pressure.
Yeah.
It is reading the behavioral footprint of your emotion.
The behavioral footprint.
Think about it like a forensic accountant looking at a crime scene.
Okay, I like that analogy.
The algorithm flags the timestamp of a losing trade. Then it meticulously measures the interval between that loss and your very next action.
Oh, I see.
Did you enter a new trade on the same ticker within 45 seconds? Did you deviate from your historical average position size, maybe doubling your risk parameters?
Did you throw your rules out the window?
Exactly. Did you ignore your usual moving average crossover setups? The AI spots that specific cluster of erratic, anomalous data points and categorizes it as the mathematical signature of a spiral.
So it's reverse engineering the psychology from the execution speed and the risk deviation.
You got it.
That makes complete sense, actually. It sees the pattern before the trader's conscious brain is even willing to admit they are on tilt.
Which is usually too late.
Right. But, diagnosing a problem during a Sunday afternoon portfolio review is really only half the battle. Autopsies are great for learning, but the actual financial bleeding happens in the heat of the moment on a random Tuesday morning.
Yeah, preventative medicine is what actually keeps a portfolio alive. Identifying the habit post-mortem doesn't get your money back.
This is where the tech pipeline shifts from passive analysis to active intervention, with Cybill's real-time behavioral alerts.
This is the feature that really changes the game.
It is. The psychological analytics engine they've built is fascinating because it answers the how. They aren't just guessing how you feel.
They're pulling in outside data.
Exactly. They integrate with wearable APIs, like pulling sleep data from an Oura Ring or Apple Health, and they combine that with quick, daily self-reporting prompts about your emotional state or confidence level before you even start the session.
That is incredible.
Right. It correlates a 4-hour sleep night directly to a drop in your trading discipline. It operates like a digital breathalyzer for your brokerage account.
Stepping in and basically telling you that you are emotionally compromised and should not be operating heavy financial machinery.
Exactly that.
And the real-world impact of that intervention is staggering when you look at the case studies. Like Sarah Chen, she's a day trader featured in the source logs who was caught in that exact revenge trading loop we just discussed.
Oh yeah, I saw her data. It showed a massive leak in capital, specifically in the hour following a stopped-out trade.
The platform caught the pattern in real time. Once the AI presented her with the hard, irrefutable data of her post-loss behavior, the denial was just gone.
She couldn't argue with the math.
Right, so she implemented a hard stop rule based on the AI's alerts, and her win rate jumped 23% in 2 months.
Wow.
And she didn't learn a magical new moving average strategy or anything. She just stopped sabotaging her own edge.
Adding 23% to a win rate purely by subtracting a negative behavior is a massive alpha generator.
It really is.
Then we have the case study of Mike Rodriguez, a swing trader. His data revealed a completely different behavioral leak. The AI processed his historical trades and discovered he consistently bled capital on Friday afternoons.
Yeah, the cognitive load of staring at charts all week just completely drained his decision-making capacity.
Which makes sense. It's exhausting.
By 3 p.m. on a Friday, his patience was gone, and he was forcing subpar setups just to, feel productive before the weekend.
We've all been there.
The alert he received from Cybill was beautifully blunt, though. It literally said, "Alert, you lose 73% of trades after 3 p.m. or stop trading late, you're tired."
That's hilarious. But it points out the ultimate irony of retail trading, which is that sometimes the most profitable action you can take in the market is to literally close your laptop and walk away.
Sometimes doing nothing is the best trade.
Having a machine mathematically pinpoint the exact hour your brain turns to mush is incredible. But I do have a concern about this real-time intervention model.
What's that?
We live in an era of notification fatigue, right? Our phones buzz constantly. If I'm trying to focus on a volatile market, isn't an AI constantly pinging me with behavioral alerts just going to induce more anxiety?
That is a very real risk, yeah, which is why the threshold programming is critical.
How does that work?
Well, institutional risk managers don't tap traders on the shoulder every 5 minutes to ask how they feel. They only step in when risk parameters are actually breached.
Okay.
The AI functions the exact same way. It establishes your baseline behavioral profile.
Yeah.
It remains completely silent while you are executing within your normal parameters, even if you are taking losses.
As long as you're following your rules.
Right. The alert only triggers when it detects that mathematical deviation, like the sudden spike in position size or the erratic time interval. It's an emergency brake, it's not a backseat driver.
That distinction makes the Emma Thompson case study even more interesting, actually.
Oh, right, the overconfidence trap.
Yeah, because her issue wasn't revenge trading after a loss. Her behavioral leak happened when she was winning. The AI detected an overconfidence trap.
Winning can be just as dangerous as losing.
Exactly. After a string of 3 or 4 profitable options trades, her risk tolerance would artificially inflate. She would start taking low-probability setups because she just felt invincible,
And she'd give it all back.
effectively giving all her morning profits back to the market by the afternoon.
See, tilt doesn't just happen when we are angry or frustrated. It happens anytime a trader loses their emotional center.
That makes a lot of sense.
Euphoria is just as dangerous as anger because it completely blinds you to risk. Catching that specific variation of tilt before it results in a massive drawdown is where the AI really proves its worth.
So, if the psychological analytics engine stops the emotional bleeding, we have to look at how the platform handles the actual mechanics of a trade.
Right, because mechanics matter.
Because a perfectly disciplined trader, entirely in control of their emotions, can still get absolutely destroyed by bad market mechanics.
Market structure is incredibly unforgiving. Newer traders often hyper-focus on finding the perfect chart pattern and completely ignore the underlying liquidity of the asset they are trading.
They just assume they can buy and sell whenever they want.
Oh, exactly. Which leads directly to the silent killer of profitability, which is slippage.
Cybill has built an industry-first volume analysis tool specifically to combat this. But let's break down the mechanics of slippage for someone who might not spend their day staring at level 2 order book data.
Yeah, it's important to understand.
Why is a lack of volume so catastrophic?
So we're talking about order book depth. When you look at a stock price on a screen, say $50, that is just the last price paid.
Right, doesn't mean that's the price you'll get.
Exactly. If you want to buy 1,000 shares right now, you need sellers willing to take the other side of that trade at exactly $50.
Okay.
In a highly liquid stock like Apple, there are millions of shares sitting at that price. But in a low-volume illiquid stock, there might only be 100 shares available at $50.
So what happens to the rest of your order?
The next seller is asking $50.20. The next one wants $50.50.
Wow. You throw a market order into that illiquid environment, and you instantly wipe out the bid-ask spread.
You chew right through.
You thought you were paying $50, but your average fill price ends up being $50.30.
Right.
Your profit margin is eaten alive before the trade even has a chance to move.
And for an active trader operating on tight margins, chronic slippage turns a winning strategy into a losing strategy very quickly.
It's death by 1,000 cuts.
Precisely. Cybill's volume analysis flags this pre-trade. It maps out which specific symbols have chronic liquidity issues and identifies the exact times of day when the order book thins out.
So it's proactive.
Yeah, it warns you that the market mechanics aren't there to support a clean entry or exit, regardless of how good the chart looks.
Flagging structural issues before a capital is committed is a huge advantage. And the data pipeline powering all of this is what really caught my attention.
The integrations are seamless.
They really are. They have integrated over 30 different brokerages directly into the platform. Interactive Brokers, Robinhood, Fidelity, Schwab, eToro.
Basically everywhere retail traders are operating.
Yeah, and you connect via a secure oath protocol, which means the platform gets read-only access. It can analyze the data, but it mathematically cannot execute a trade or move funds.
Security is paramount. The moment a third-party application requests write access or API trading privileges, the risk profile changes entirely.
Nobody wants a third party having the ability to buy and sell for them.
Exactly. A read-only analytical layer keeps the capital secure while extracting the value of the data.
And for brokers not on the native integration list, they build a universal CSV parser that auto-detects column formatting. So the days of manual spreadsheet entry are totally over.
Thank goodness for that.
But the most impressive logistical feature, in my opinion, is the true multi-currency journal. The engine automatically detects and calculates real-time conversions for Australian dollars, US dollars, British pounds, euros, Canadian dollars, Japanese yen, and Hong Kong dollars.
Operating in a global market makes that feature a necessity rather than a luxury.
It sounds so complicated to manage manually.
It is. A trader based in London might be executing strategies on U.S. tech equities in the afternoon and hedging with the Australian ASX 200 overnight.
Oh, wow.
Trying to calculate actual net profitability across 3 different fluctuating exchange rates in a static Excel spreadsheet is an administrative nightmare.
And it introduces too much room for calculation errors.
Exactly. Automating the currency conversion allows the trader to focus entirely on execution.
The feature that really bridges the gap between raw data and actual execution, though, is their TradingView integration.
This is where it gets really advanced.
TradingView is the industry's standard charting software where most technical traders build their strategies and set up their alerts. Cybill connects to it using webhook technology.
Which is much faster.
Right. To put that in perspective, think of a standard API request like you sitting in the backseat of a car constantly asking, "Are we there yet? Are we there yet?"
Yeah.
It's inefficient.
Very noisy.
A webhook is entirely different. It's the server instantly sending you a text message the exact millisecond you arrive.
It creates an instantaneous data bridge. But, plenty of platforms can receive a signal. The real value is in what the platform does with that signal once it arrives.
It doesn't just pass along a dumb notification. When a TradingView strategy generates a buy or sell signal, that raw JSON payload is sent directly to Cybill AI via the webhook.
And then the magic happens.
The AI instantly processes that signal through its risk assessment engine in real time. Let's trace the specific example provided in their technical breakdown.
Okay, let's hear it.
Assume your TradingView script triggers a long position alert on Apple stock on a 15-minute time frame with an entry price of $150.25.
A standard binary technical trigger based purely on price action and indicator alignment.
The moment that trigger fires, Cybill intercepts it, runs its analysis, and pushes a comprehensive notification back to the trader. The AI output reads, risk level, medium, strong bullish momentum detected, technical indicators align well. Consider taking this trade with proper position sizing. Stop loss recommended at $148.50.
That is incredible.
It transforms from a simple messenger into an analytical co-pilot.
Because bridging the gap between theory and execution is the hardest part of trading. An indicator can tell you to buy, but it rarely tells you how much to buy or where you are mathematically proven wrong.
Right, it doesn't give you the exit strategy.
Providing a dynamically calculated stop-loss recommendation right inside the alert forces the trader to acknowledge the risk before they focus on the reward. It turns a raw signal into a fully baked, risk-managed trade plan.
And the platform also tracks the historical performance of those specific webhook signals. You might discover that one proprietary TradingView script you bought online actually has a solid 60% win rate, but another indicator you rely on is bleeding capital with a 30% win rate.
It brings absolute, ruthless accountability to the technical tools a trader uses.
Which we definitely need.
Retail traders are notorious for indicator hopping. They bounce from RSI to MACD to Bollinger Bands without ever systematically back-testing or forward-testing the statistical edge of those tools over a large sample size.
And they just trust the shiny new thing.
Right. The AI forces you to confront the math behind your strategy. If the indicator doesn't generate positive expectancy over 100 trades, the platform will show you the exact dollar amount that indicator is costing you.
Which really speaks to the overarching mission of the platform. Cybill AI is fundamentally not a digital diary where you passively jot down your thoughts after the market closes.
Not at all.
It is an active, aggressive engine designed to force a permanent transition from emotional, reactive gambling into data-driven, disciplined trading.
Removing the chaos of the human mind from the execution process and replacing it with cold, hard probability.
And the accessibility of the tool makes this transition incredibly viable. They offer a completely free tier with no credit card required, though it is capped at 30 lifetime trades.
It's enough to get your feet wet.
Exactly. It functions as a proof of concept, allowing a trader to import a small batch of historical data and watch the behavioral engine diagnose their leaks.
A taste test to prove the validity of the algorithm against your own past mistakes.
Yeah. And the Pro plan, which unlocks the unlimited trade imports, the multi-currency conversions, the real-time volume analysis, the Aura Ring integrations, and the TradingView webhooks, runs at $37 a month.
Honestly, framing that cost through the lens of risk versus reward makes it almost a negligible business expense.
How so?
Well, consider Mike Rodriguez losing 73% of his trades on Friday afternoons because of decision fatigue. Or Sarah Chen, caught in a post-loss revenge trading spiral.
They were losing way more than that.
Exactly. Most active traders will recover that entire $37 monthly subscription cost simply by having the AI step in and talk them out of a single bad FOMO-driven trade.
Protecting capital by avoiding one catastrophic mistake, basically pays for the software for the month.
In the markets, the money you save by refusing to take a low probability setup is functionally identical to the money you make on a winning setup.
That's a great way to look at it.
Capital preservation is the only metric that matters in the long run. A tool that acts as a guardrail for that capital pays for itself exponentially.
It also includes broader market features, like a stock screener covering the ASX 200, the U.S. markets, and the FTSE, alongside economic calendar integrations and news sentiment analysis.
So it's an all-in-one hub.
Yeah, it operates as a central command station, tracking macroeconomic events so you aren't blindsided when, the Federal Reserve suddenly releases a report and the market violently whipsaws.
Structure is the only reliable antidote to the emotional chaos of the markets. The days of relying on a gut feeling or instinct are just over.
The machines are too fast now.
The algorithmic trading firms are too fast, and the data is too readily available. You either adapt and use that data to understand your own flaws, or the market will efficiently transfer your wealth to someone who does.
Which leaves a final, broader thought for you to mull over today. We have spent this deep dive looking at how an artificial intelligence can ingest a basic spreadsheet of your buys and sells, correlate it with your sleep patterns, and accurately map your emotional blind spots.
It's slightly terrifying, actually.
It really is. It can pinpoint your hidden habits, the exact hour your decision-making degrades, and the moments when overconfidence makes you reckless. It identifies your deepest behavioral flaws purely by examining the exhaust fumes of your financial data.
The behavioral footprint is permanent.
If an algorithm can understand your psychology, that clearly, just from your broker history and an API feed, where else in your life are you leaving a hidden trail of data that a machine could understand more clearly than you do?
That's a heavy question.
Whether it's your fitness tracker, your screen time, or your bank account, the data does not lie. It is just waiting for a mirror to show you the truth.
A powerful reality to confront. Know your data, know yourself.
Until next time, keep diving deep.